In public sector finance, transparency and accuracy are essential for public trust. Ipsas provides a global framework for clear, consistent government financial statements. Ipsas 21, impairment of non-cash generating assets ensures reported asset values reflect their true service potential. If an asset's ability to provide public services drops, its value must be reduced. This is called impairment. Ipsas 21 prevents overstatement of public assets, giving a realistic view of government resources. Without this standard, losses in asset value might go unrecorded, misleading stakeholders. We'll explore what non-cash generating assets are, how to identify impairment, and the journal entries required. Mastering these concepts ensures financial statements are both compliant and truly representative. Let's dive into the core principles of Ipsas 21. Non-cash generating assets are held to provide public services, not to make a profit. Examples include schools, parks, roads, and government buildings. Their value is based on their service potential. Impairment is a sudden, significant decline in this potential, beyond normal wear and tear. Triggers include physical damage, obsolescence, or closure of facilities. Recognizing impairment ensures financial statements reflect the true operational capacity of the entity. Ipsas 21 requires entities to test for impairment when there are signs of lost service potential. This discipline keeps asset values honest and supports responsible financial management. To assess impairment, compare an asset's carrying amount to its recoverable service amount. Carrying amount is the asset's recorded value, original cost minus depreciation and prior impairments. Recoverable service amount is the higher of fair value less cost to sell or value in use. For public assets, value in use is the present value of remaining service potential, often estimated by depreciated replacement cost. If carrying amount exceeds recoverable service amount, the asset is impaired. The difference is recognized as an impairment loss, an expense in the financial statements. For example, if a library's carrying amount is $8 million but its recoverable service amount drops to $5 million, a $3 million impairment loss is recorded. This adjustment ensures asset values reflect their actual utility. Accurate impairment recognition prevents overstatement and supports informed decision-making. Ipsas 21 enforces this reality check in public sector accounting. Once impairment is measured, it's recorded with a journal entry: debit impairment loss, expense, and credit accumulated impairment losses. Using our library example, debit impairment loss $3 million, credit accumulated impairment losses, buildings, $3 million. This reduces the asset's carrying amount to its new recoverable service amount. Future depreciation is based on this revised value. The entry ensures financial records match the asset's diminished service capacity. Timely recognition keeps statements accurate and transparent. Sometimes an asset's value recovers. Ipsas 21 allows reversal of impairment if service potential is restored. A reversal is only allowed if the original impairment's cause is resolved. For example, if a library is modernized and its recoverable service amount rises from $5 million to $7 million, a $2 million reversal is possible. The reversal cannot increase the asset's value above what it would have been without impairment. The journal entry: debit accumulated impairment losses $2 million, credit reversal of impairment loss income $2 million. This restores part of the asset's value and recognizes the gain in the financial statements. Strict limits prevent overstatement and ensure reversals reflect genuine recovery. Ipsas 21 maintains integrity in both loss and recovery. Ipsas 21 requires vigilance for impairment indicators, both external like regulatory changes, and internal like physical damage or obsolescence. Regular monitoring is essential for good asset management. Remember, Ipsas 21 applies only to non-cash generating assets. Cash-generating assets follow Ipsas 26, which aligns with private sector standards. Correctly distinguishing asset types is crucial for compliance. Mastering Ipsas 21 ensures fair, transparent reporting of public assets. Accurate impairment recognition upholds the integrity of financial statements. This fosters accountability and public trust in how resources are managed. Diligent application of these principles is the foundation of responsible public sector finance.